Welcome back, everyone. Now we're going to be working on job order cost systems. There are two types of cost accounting systems, job order costing systems and process cost systems. Process cost systems are a little bit more complex, so it's better that we start off with job order, um, primarily so that you can get a handle on the journal entries that are required with job order costing systems. Now, let me tell you a little bit about the differences between the two. Job order costing systems are better used when you have unique products or items that are easily distinguishable from one another in order to track costs appropriately. A process costing system is better utilized when you have a large number of the same exact type of product. So, if, for example, if you were making Coca-Cola, or you're making vats of ice cream, or if you were making um, nuts and bolts. All those things are exactly identical to one another, and process-based costing tends to work out better in those systems. So, like I said, job order costing is better when you're trying to when you're what you're doing is keeping a separate record of the costs of the product that you're making. So at the end of the day, when you're finished with your product, you know exactly how much it cost to make that specific product. Now, what we're going to do is we're going to use what I might keep referring to the example that is used throughout your book, which is you're making custom guitars, which definitely falls into the job order costing system. You start off with a very specific amount of material, you produce the product, you're working on it with this work in process account. It goes to a finished goods, and then when you sell it, it becomes cost of goods sold. We're going to take all this through as T accounts, and this way you can see how the actual costs flow through your journal entries. To start this off, what's going to happen is that a number of items are going to go into your WIP, your work in process. Those items that are going to fall into your WIP are going to be your direct materials, any direct labor, your factory labor, and factory overhead, which we'll talk about a little bit more in detail when we get to that part. From there, we're going to transition the WIP to finished goods, and we're going to show you how it works I'm going to show you how it works when you sell the item. And we're going to talk a little bit about the journal entries for period costs as well, and give you some examples of what period costs might be. So with that, let's start getting to our actual journal entries. The first step in any process is, of course, to actually buy the material. So looking at the journal entry for buying material, it's as simple as a debit to materials of some amount and a credit to either cash or accounts payable, presuming you still owe the money. So that's where it looks like first. Very first entry. We're buying materials and we either pay for it right up front with cash, so it'd be credit to cash, or a credit to payables. Okay, so what that looks like from a T account perspective. So looking at it from a T account, here you go. Here's your debit to materials. I'm not going to put amounts in. I'm just going to put X's because my real goal here is to show you how the costs flow from account to account. So I didn't include the one for accounts payable or cash, because that's pretty much done here. The real focus I want to spend time on is, as I said, how the materials flow into work in process, how that flows into being a finished good, and how that flows into being cost of goods sold. So starting off, here's our purchasing of materials. You've got your debit to materials. Now, your next step is to put those materials into work in process. So actually, I'm going to make a work in process account right over here. And I'm going to shorthand it by just saying WIP. So here's my WIP account. And when I decide that I'm going to take materials out of here, out of my inventory of materials, and I'm going to put some materials, oops, that's not the right thing. I'm going to put some materials into process. I'm going to start working on maybe my first guitar. What I'm going to do is I am going to credit materials, and I'm going to debit my WIP. So really what I'm doing here is I'm taking items out of my materials, which is an asset. Well, they're all assets. This is just various classes of inventory. I'm going to take the materials out of here, and I'm going to put it into my WIP. Let's see if I can figure out. I think an arrow is beyond me, but at least I can do this. All right, so that's where we are right now. We're putting the materials, we're taking them off the shelves, and we're putting them into the work in process. So the journal entry for that is a debit to WIP, here it is, and a credit to your materials. Okay, so this is the journal entry for putting materials in my WIP. bold these so I give them good separation. All right, our next step, those are our direct materials that we're putting into WIP, basically. So if you're talking about guitar, you're talking about the wood, the strings. That pretty much is all of my guitar knowledge. So those are the items that I'm going to say are going in for direct materials into my WIP. The next thing that we're going to be putting into our WIP is we're going to be putting direct labor into WIP. Now this is going to be the people actually physically with their hands on the guitar, creating it, however that works. Um, this is going to be the cost, there's the pay, if you will, the salary and labor costs associated with those people. So it's going to be a debit to WIP because you're putting them into WIP. Remember, WIP isn't just an assets, just another inventory account. You're putting it into WIP, and your credit is going to be to maybe wages payable. Okay, so now if you remember way back, reaching back to your financial accounting days, normally it would have been, if you had wages that you had to pay, it would have been a debit to wage expense and a credit to wages payable. Well, it's not a debit to wage expense anymore. Instead of it going to an expense account, those types of items are going to go directly into your WIP. So let me put it in T accounts now. All right, so I have my wages payable account here. And you see I've got the amount here, and that amount is going to go into my WIP. And you know what? I think I'm going to change the way I'm representing this a little bit. I'm going to, just so I can keep it like this. This is going to be my direct labor that's going in to my WIP. It would really be in a dollar amount, so that's why I'm using X's for the dollar amount. But I think it might be helpful to you for illustration purposes if I at least use, oof, that's not going to work out well. How about MATLS? How's that for materials? That's clear, right? Let me make sure I'm not losing my direct labor. Oops. Uh-oh, bad things just happened. I lost my direct labor. All right, so here we go, direct labor. All right, so what we've got going in so far is we've got materials and we have direct labor. Now let's talk about that factory overhead account for just a minute. All right, now factory overhead is basically all the manufacturing costs except for direct materials and direct labor. So anything else that you need in order to create this guitar needs to fall into here. So you're going to have indirect materials. So an indirect material for a guitar might be sandpaper. All right, you need it, but it's not something that makes sense to quantify, to say, oh, well, it takes 6 pieces of sandpaper in order to make this guitar. It's just not necessary. It's not expedient. It's not efficient. So another example of indirect material might be the oils that you need in order to polish the guitar. All right, it just doesn't make sense to quantify those items. So, but you do need them in order to prepare a guitar, or maybe even glue, something like that. Those items would be indirect materials. You would also have indirect labor. If you want to think about, that's your business, you're making guitars. An indirect labor item might be the salary of the person who uh, supervises the factory. All right, so their hands aren't actually on a guitar, but you do need that person who's supervising the factory in order to make guitars. All right, you certainly need things like electricity. You need things like depreciation on the warehouse. All of those things are necessary costs to building that guitar, but they don't actually have a direct application. They clearly are not direct materials and direct labor. So what you're doing in this factory overhead account is you're accumulating all of these costs. There's so many of them, and you're accumulating them into one massive account called factory overhead. So what you're going to do is you're going to debit factory overhead for some amount, whatever that amount might be. And your credits are going to be to various things. They're going to be to materials, right, which would be your indirect materials only. Maybe some wages payable, like I said, for the supervisor's salary or something like that. You might have accumulated depreciation. Okay, you might have any of these types of items. You might have um, property taxes payable. Now, normally, reaching back again to financial accounting, what you would normally have is you would have these be expenses. You would say it would be a debit to a depreciation expense, a credit to accumulated depreciation, or a debit to property tax expense, credit to property taxes payable. Right? So reaching back, that's what it would normally be like. However, since these are costs of making the product, they're all going to get added together into the cost of the product itself. You needed these items to build a product, so they're all going to be added together and become part of that total product cost. So for right now, we're dumping them all into factory overhead, okay? So any number of things is going to wind up in here. All right, let me put it into a T account.